On today's hot sheet, I'm discussing housing inventory, mortgage lending in Q3, and Realtor.com's forecast for 24. Today is Monday, December 4th, 2023. I am Byron Lazine, and the hot sheet starts now. Good morning, and welcome to today's hot sheet. Glad to have you here. Glad to have you after the weekend. Let me know in the comments in the live chat which market you are tuning in from. I'm tuning in from my Naples, Florida studio. I'll be back in my Connecticut studio throughout the week. Hit subscribe and the thumbs up button if you are enjoying this hot sheet. All right, let's get right into the inventory update as we do every single Monday. It's what we are tracking closely in this market. It's what can impact affordability, which is our biggest issue in the housing market more than anything else, is the inventory crisis that has kind of just grappled us here for quite some time. In the last few weeks, we actually got net positive from year over year on inventory. Okay. And we remain there today, which is really good news. The weekly inventory change, my apologies on that. And I'll show you here the chart. Weekly inventory change here for the country, according to Altos Research, is from 565,000 down to 555,717. Okay, so you may hear down in the week over week with where we are right now and be thinking, well, that isn't good. But in fact, we're above where we were last year. Last year, we moved down from 564, 571 to 550,302. So we lost about 15,000 active listings last year during the same week, according to Altos Research, where this week in 2023, we only lost 10,000. So we're starting to get now small numbers coming off of a real low, obviously, in inventory. We're starting to get a little bit healthier situation here in the winter as it relates to inventory. Last year, according to Altos Research, the seasonal peak for housing inventory was October 28th. It appears that the seasonal peak this year was November 17th. So it's getting pushed later. And we have a higher number now than we did at this time last year. So year over year right now, we are finally net positive on inventory as opposed to net negative where we've been most of the year. Of course, if we look back to 2015, we're way out of alignment there, where we had active listings for this week at 1,081,000. So we have about half of that right now. Obviously, we're not in a position to compare to that, but if we compare to last year, we see that things are doing much better. Okay. Now let's take a look at the new listings, because if we can get some more new listings, we're obviously going to be in a position to accumulate inventory faster. Now, I said last week when we looked at this data that new listings, if we were to, we'll see if we follow this 2022 spike on new listings, then obviously we're in that seasonal time frame. But if we were to buck the trend, then that would mean a brighter future for inventory. We didn't do that. Okay. New listing data for this past week was similar to last year, almost exact 28,297 for this week. Last year, same week, 28,471. So we're on the same trajectory that we see new listings here. That's obviously having a lot to do here with Thanksgiving. It just plummets. Then what you typically see is a spike up. Last year, this week that we're entering now was 39,419. In 21, it was 47,000. Our hopes are that we would spike up somewhere into the 50s. That'd be the hope here, that we would outperformed the last 2 years on new listings before we see another drop as you lead into the end of the year holidays. This is the week. If you're just looking at the last couple of years, and historic data will tell you the same signal, this is the week in December where the majority of the listings in any given week are going to come for the month of December. When we're looking back, it's this week, it's right now, it's the next 7 days for real estate agents to get the most listings, biggest listing week of any other week on the calendar left in 2023. It's right now. It's what the historic data shows us. It's what the last couple of years has shown us. So if you're looking for listings in December, jack up those appointments this week. Now is the time to capitalize them. Looking back, that's what the data shows us. Price cut percentages this week over the last few years. Price cut percentages this week were 39%. That number does continue to tick up a little bit. 43% in 22 and 27% in 2021 for the same week. Now looking ahead at home mortgage lending. And this is a report out of ATTOM. Home mortgage lending declines again across the U.S. during the third quarter as mortgage rates climb. Now, we know that the last few weeks, we've seen mortgage demand actually go up. We talked about that last week. I think we brought that up on the free format Friday on last week's hot sheet. ATTOM, a leading curator of land, property, and real estate data, released its third quarter 2023 U.S. property mortgage origination report, which shows that 1.5 million mortgages secured by residential properties, 1 to 4 units, were issued in the United States during the third quarter, representing a 3% decline from prior 3-month period. That drop-off marked the 9th decline in the last 10 quarters, a string broken only by a spike during the second quarter of this year. Okay. Residential loans dropped 3% in Q3 after a brief surge in quarter 2. Purchase and home equity lending both decreased by 7%, while refinance activity increased for the second consecutive quarter. 1.54 million loans as issued in quarter 3, made up that 3% decline. Total residential lending was down 26% from a year earlier and 63% from the peak in 2021, as expected when you ratchet up rates as quickly and as high as they were. Lenders issued a total of $482.5 billion in residential mortgages in quarter 3, 2023. That's a big number still. Okay, there's a big market still out there. And we know that over 30% of purchases were happening with cash. So the greater purchase market was even bigger than that number of $482.5 billion, representing a 4% decrease from quarter 2 and a 28% decrease from Q3 in 22. Refinance activity increased by 5% quarterly, reaching approximately 516,000 loans. Here's a quote from Rob Barber, CEO at ATTOM. The mortgage industry took another hit in the third quarter as a spike in residential lending during the spring turned out to be temporary. Refinance deals stood out as the lone bright spot. It's crazy to hear that with how off refinance deals have been. That seemed a bit odd given that interest rates went up, but may have stemmed from home owners pulling cash out of their growing equity. It's like, I got this equity, don't want to sell the house. What's another option to tap into it? It's to refi that portion of the equity. Overall, the impact of higher rates and other forces working against borrowers remains striking, resulting in a total loan activity still off by a remarkable 2/3 over just 2 years. Some other factors that are influencing these trends: higher mortgage rates and other forces worked against borrowers, resulted in a remarkable 2/3 decrease in loan activity for over 2 years. Typical fall housing market slowdown, what we've seen in the last couple of months, is expected to further reduce purchase lending, although we've seen mortgage demand actually go up the last few weeks, while borrowing by homeowners may remain steady if interest rates stabilize. Okay, interest rates have stabilized, and we've seen that pop up. Some regional trends here. Total lending activity decreased quarterly in almost 2/3 of the analyzed metropolitan statistical areas. St. Louis, Missouri, experienced the largest quarterly decrease in total lending, followed by Atlanta, Georgia. So that's where the two biggest decreases for mortgage lending took place. All right, let's jump into Realtor.com's 2024 market forecast predictions. Housing affordability finally is going to begin a turnaround, says Realtor.com. This is the time of year where we're looking at all of these projections. All right. Realtor.com forecast for key housing indicators. Let's take a look at the top line ones right now. The 2004 RDC forecast for mortgage rates is a 6.8% average, ending the year at 6.5%. So we're sitting here in the low sevens right now. I'm hearing from many of you, local, different local areas across the country, that you're able to get, folks into high sixes right now, depending on their qualifications. This is where Realtor.com suggests that we're going to be averaging throughout the year. Okay. Historical data, of course, is at a 5.3. 2022 historical data shows us 5.3% average, 6.4% year end. This year, we know where we're going to end up here in the sevens, and the full year is about at a 7. 2013 to 2019, we were at a 4% average, just for some historical context there. Existing home median price appreciation, Realtor.com has this year over year at negative 1.7% for 2024. Existing home sales, they do have us up basically flat or just up a tick to 4.07 million for existing home sales for Realtor.com. Existing home for sale inventory, they have going down yet again. That'd be detrimental. I don't know where they say affordability is going to lean up. Existing home for sale inventory going down 14%. This would be detrimental to affordability, not helpful at all. I'm hopeful that number will go up. They have it going down based on their projection. This year, we only went down 5.7%, according to Realtor.com. So going down 14% would not be good. Single family home housing starts, they have up 0.4% at a 0.9 million. Home ownership rate at 65.8%. That's up from 64.2% on the 2013 to 2019 run. Rent growth down negative 0.2%. We're up 0.2% this year, according to Realtor.com. So that deceleration on rent growth, rent pricing will continue. Now, here's what they say about inventory. Expect a stormy market as inventory drops by up to 14%, leaving fewer options for buyers. It dropped 4.4% in 2022 and then another 5.7% this past year. That would be stormy. I'd agree with you, Realtor.com. That'd be incredibly stormy if we dropped another 14% on inventory this year. So Realtor.com's take is that this Cold War, this lock-in effect, just continues long term. They don't see it loosening up. They don't see what Zillow said is home. Zillow, when they did their forecast, and we covered it last week, they saw that some homeowners are just going to say, you know what, we're getting fed up with the waiting game. We're going to ultimately, just go and make that move for our lifestyle. Realtor.com doesn't see that at all, based on this projection that inventory goes down, because this would lead me to believe that less homeowners are going to be comfortable with the rates, and they're just going to stay locked in. This is what Realtor.com's thoughts are. Home prices. This is one of the more, I guess, now becoming normalized, because a lot of people have home prices at flat or under. So maybe not more bearish, but on the bearish side of home prices, because you still have some in the positives. Consumers are going to see some sun as home prices come down by almost 2%, but that wouldn't make up, when it comes to home buyer affordability, that wouldn't make up for a 14% loss in inventory. So I don't see where Realtor.com, this is Realtor.com saying home prices dip, improving affordability. Well, if there's 14% drop in inventory, this is a simple supply and demand curve, realtor.com. Okay. If you have 14% drop in inventory, and we've actually in the last 3 or 4 weeks, as rates have come down to 7, you're suggesting that they're going to be an average of 6.8. As rates stabilize, we've actually seen mortgage demand the last 3 or 4 weeks go up, according to Mortgage Banker Association. So this would mean, demand goes up or demand stays the same. Supply dramatically reduces. What happens to prices? Okay, there was like this economics course 101. I don't have a college degree, but you can Google this stuff. Prices go up in that instance, but yet you have prices going down 1.7%. I'm just going to say, I don't think, I look at a lot of these forecasts and a lot of them do end up being wrong. Like realtor.com, you're setting yourself up to just be dramatically wrong because everything, it's like an oxymoron here. Okay. That home prices are expected to dip 1.7% in 2024 as maxed out buyers lose their sense of urgency. Now, I can get with the argument that there are going to be some buyers that just lean into going and there's, a lower in cost of rent. They're going to go rent, especially with the inventory surge that's coming in the rent market. I can get with that. And that's the argument that Zillow made in their projection was the new starter home is the single family rental. So I can get with that, but is it going to be when you have a 14%, this is your projection, not mine. I don't believe this 14% drop in inventory. Can you even imagine a 1.7 drop in prices? They're still, listen, talk to agents across the country. Just look at when median price homes hit the market in almost every MLS, how much demand is on those. There's still sufficient demand for that product. And I believe it's still going to be sufficient enough to, soak up those homes and push those prices up. If we had a 14% drop in inventory, I certainly hope we don't for the affordability of home buyers. Home sales expected to remain steady. And so what you're saying here is supporting my point of this whole report lacks a chance of being viable in the future. Okay. Home sales expected to remain steady as mortgage rates ease. So you're saying rates are easing, sales are going to remain steady at this pace. You actually have them up a tick. So you're saying that demand off of this year is going nowhere, but that supply is plummeting. And yet prices go down. I can't, 1 + 1 does not equal 2 here. I can't make sense of it. Sustained improvement in inflation expected to bring mortgage rates down to 6.5% by the end of 2024. Love that. This I love. I'd love for it to be lower. In fact, when you look at Logan Mohtashami's report this morning that we reviewed earlier with the Altos research, he says if you had a normal spread between the 10-year and the 30-year right now, rates would be less than 6% today. Now, we haven't seen a normalized spread for quite some time, but you could start to see a normalized spread by the end of the year if inflation does continue to cool. So this number, there's a case for this number going lower than projections. Now, realtor.com is in line with most projections as it relates to higher for longer interest rates. For sale inventory forecasted to fall 14.7%, but new construction and rentals provide relief valve. Yeah, rentals will be there for folks. New construction is higher than most can afford. The trend line here, to realtor.com's credit, this would follow a trend line of consistently moving down. And maybe it does fall 14%, but you can't also say that home prices will go down 1.7% if this were to happen. Home prices push up if this happens. They definitely go up again if that were to happen. Mortgage rates 6.7% expected to be higher than existing rates on 85%. Interesting stat here. Rates, if they go to 6.5%, expected to be higher than existing rates on 85% of mortgages. Less than 6% at the end of 2024. Yeah. And that's maybe why they're talking about that supply dropping as a lock-in there. Rents expected to soften 0.2%. even as multifamily starts slow due to record construction pipeline. They're slowing now because the multifamily investors and operators knew they got ahead of themselves on how much inventory they're bringing onto the market. They're just bringing a wild amount of inventory. Here's speaking of wild, here's Realtor.com's wild cards, almost like the NFL wild card weekend. With both mortgage rates and home prices expected to turn the corner in 24, record high unaffordability will become a thing of the past. Though, as noted above, return to normal wouldn't be accomplished within the past year. The prediction hinges on the expectation that inflation will continue to subside, enabling the recent declines on longer-term interest rates to continue. If inflation were instead to see a surprise resurgence, this aspect of forecast would change. Home sales could, I don't even know what that means. Wildcard 2, geopolitics. Ooh, juicy. In our forecast for 23, we say the risk of geopolitical instability on trade and energy costs as something to watch. In addition to Russia's ongoing war in Ukraine, instability in the Middle East has not only had a catastrophic human toll, but conflicts have the potential to impact the economic outlook in ways that cannot be fully anticipated. The market seems to, I'm not going to touch the politics or the human toll or any of that kind of stuff, Realtor.com, but the market seems to say, hey, and Realtor.com saying instability in the Middle East, certainly an unstable situation, but the market seems to see, some ending to that, where the market has not been able to price in an ending to, Russia, Ukraine, just away from where investors think about it. That's what we've seen in the last, few weeks as well. As it relates to the market. Wildcard 3, domestic politics, 2024. We got the elections here. So Realtor.com leaning into the politics a little bit here. In 2020, upheaval of pandemic era adaptations. Many Americans were on the move. We noted that Realtor.com traffic pays indicated home shoppers, traditionally blue or Democratic areas, were tending to look for homes in markets where voters had typically voted red or Republican. The consumers also reported preferring to live in locations where their political views align with the majority. Few actually reported wanting to move for this reason alone. I don't know if the 24 elections are going to have that big of an impact on how people are moving. Certainly, it's going to suck the air out of a lot of news and media outlets throughout the year. That'll be a certainty. Okay, so you can read more about Realtor.com's projections. I think those are some of the top line ones that were interesting. What's most interesting to me is actually where the 10-year ended last week and where it sits today. It's under that 4.3 level, which we hit last week at one point for the first time since September, and we're back down to 4.259. This means we could very well hit a 30-year fixed mortgage news daily report today in the sixes. We could, not saying we will, but we could. We ended last week at 7.09. There are some folks getting locked in the sixes right now. The weekly report was at 7.22. That should come down lower this week. We could see a six handle. We could be back at the sixes. This is great news for home buyers. Make sure you let them know about that. And make sure you let agents know about, and everybody in real estate know about this show, The Hot Sheets, the only live daily housing show on the internet. Hit subscribe, hit the thumbs up if you enjoy this show each and every single week. And if you want the most out of BAM, make sure you get into BAM X. Use code HOT to get 10% off of BAM X. Prices went up on Friday, and they continue to go up into the future as we continue to add more content. But your price gets locked in. Our OGs got locked in before December 1st on a ridiculously low price for life. You can still get locked in on a low price by using code HOT to get 10% off of BAM X. I hope everybody has a great start to their week here on this Monday. Look forward to seeing you guys back here tomorrow, live at 9:30 on the East, 6:30 on the West. Until then, toodaloo.